Welcome to UK Property Info. Something genuinely strange is happening in the UK housing market right now, and I've spent the past several weeks trying to make sense of it. The patterns we have relied on for decades to understand how the property market behaves have stopped working. Data that should point in the same direction is contradicting itself. Indicators that have always moved together are now moving apart, and the explanations that experts usually offer are failing to account for what we are actually seeing. Before I walk you through exactly what has changed and why it matters for anyone buying, selling, or investing in property, I want to ask you to subscribe to this channel if you find this analysis valuable. That simple action helps this channel grow and allows me to keep producing independent property analysis. Now let me show you the strange new reality of the UK housing market and explain what I believe has fundamentally changed. Let me start with the most obvious contradiction, because it perfectly illustrates why the current market is so confusing. House prices nationally are falling. We have seen declines of 10 to 15% in real terms over the past 18 months, and in some areas the nominal falls have been significant too. Now, in any normal market cycle, falling prices would attract buyers. Affordability would improve, demand would increase, and transaction volumes would rise as people took advantage of better value. That is how property markets have always worked. Falling prices stimulate demand, which eventually stabilizes prices. But that is not happening this time. Transaction volumes have collapsed by over 30%. Instead of falling prices bringing buyers back into the market, buyers have retreated even further. The normal relationship between price and demand has broken down, and nobody in the industry can fully explain why. Here is another strange pattern. Rental demand should be inversely related to buying demand. When people cannot afford to buy, they rent instead. When buying becomes more attractive, rental demand softens. This relationship has held for decades, but right now both rental demand and buying demand are falling simultaneously. Rental inquiries have dropped over 20% in many areas, while buyer inquiries have dropped even more. People are not switching from buying to renting or from renting to buying. They are withdrawing from the housing market entirely. They are moving back with parents, taking in lodgers, house sharing with friends, or simply staying put in unsuitable accommodation rather than participating in either market. This is not normal economic behaviour, and it suggests something fundamental has changed about how people are interacting with housing. The third contradiction involves supply and price. In normal markets, when supply increases, prices fall, and when supply decreases, prices rise. Basic economics. But the UK market is currently experiencing falling supply in the sales market, while prices continue to fall anyway. There are fewer properties listed for sale than at almost any point in the past decade, yet prices are not being supported by this scarcity. Meanwhile, in the rental market, supply has collapsed even more dramatically, with over 300,000 properties lost from the sector in 3 years. Yet while rents have increased, they have not increased anywhere near as much as such a severe supply reduction would normally cause. The price signals are not responding to supply changes in the way economic theory predicts they should. So what has actually changed to create these contradictions? The first and most important shift is that we have moved from an era of falling interest rates to an era of stable or rising interest rates for the first time in nearly 40 years. From the mid-1980s until 2021, the general trend was always towards lower rates. There were fluctuations, of course, but the direction was consistently down. An entire generation of property investors, homeowners, estate agents and analysts built their understanding of the market in this environment. Every model, every rule of thumb, every piece of conventional wisdom was developed in a world where money was getting progressively cheaper to borrow. That world has ended. Interest rates have risen from near zero to over 5% in the fastest increase since the 1980s. And this is not a temporary spike. Rates are likely to stay elevated for years. The mental models everyone uses are simply not designed for this environment. The second major change is the breakdown of wage growth and house price correlation. For most of the past 50 years, house prices and wages moved in roughly the same direction, even if houses rose faster. When wages grew, house prices grew. When wages stagnated, house price growth slowed. This correlation gave people confidence that even if houses were expensive, they would become more affordable over time as wages caught up. But we have now entered a period where real wages are falling. while house prices remain elevated. The cost of living crisis has eroded purchasing power in a way that has not happened for decades. People are not just unable to afford houses at current prices, they are actually becoming less able to afford them with every passing month as their real incomes decline. This removes the hope that traditionally kept aspiring buyers engaged with the market. The third change is the collapse of transaction chains. The UK property market has always functioned through chains where buyers and sellers connect in sequences. First-time buyers enable existing owners to move up, who enable downsizers to move, and so on. When one link breaks, the whole chain fails. What we are seeing now is chains failing at an unprecedented rate because every participant faces different problems simultaneously. First-time buyers cannot get mortgages at affordable rates. Existing owners cannot sell their current properties. Downsizers cannot find suitable smaller properties because they have been bought by investors or are now rentals. Every link in the chain is broken at the same time. This has created a paralysis in the market that has never occurred before to this degree. The fourth change is the divergence between headline data and lived experience. Official statistics suggest the market is experiencing a moderate correction. Prices down a few percent, transactions down somewhat, a normal cyclical adjustment. But talk to anyone actually trying to buy or sell, and you hear stories that bear no resemblance to these statistics. Properties sitting unsold for 18 months. Buyers having offers rejected, then watching the same property get reduced by £50,000 3 months later and still not sell. Sellers being told their home is worth 30% less than identical neighbours sold for 2 years ago. Renters being outbid by dozens of applicants and offering 6 months' rent up front just to secure a viewing. The gap between what the data says and what people experience has never been wider. The fifth change is the policy uncertainty that is paralysing decision-making. Potential buyers and sellers are frozen not just by current conditions, but by fear of what might come next. Will interest rates rise further or fall back? Will the government introduce new schemes that change affordability? Will there be tax changes that affect property ownership? Will leasehold reform reduce the value of flats? Will rent controls be introduced that affect landlord returns? Will building regulations change what can be insured or mortgaged? Every major decision in the property market now involves a bet on future policy, and nobody knows what policy direction will be taken. This uncertainty is causing people to delay decisions indefinitely rather than risk making the wrong choice. The sixth change is demographic, and it may be the most significant of all. We are witnessing the first generational handover, where the inheriting generation cannot afford to engage with the property market on their own terms. Previous generational wealth transfers saw children inheriting from parents and using that inheritance to buy bigger homes or help their own children onto the ladder. The current transfer is seeing children inheriting from parents and using that inheritance just to clear debts or supplement inadequate pensions or pay rent. The inheritance is not flowing into the property market because the inheritors have more pressing needs. And those who do use inheritance for property are often just buying their first home in their 40s or 50s rather than trading up as previous generations did at that age. The demographic engine that drove property market growth for decades is sputtering. What makes all of this so strange is that the market should be self-correcting, but it is not. When prices fall, transaction volumes should rise, but they are falling. When supply drops, prices should rise, but they are falling. When rental supply collapses, rents should explode, but they are rising moderately while demand falls. When mortgage rates rise from 2% to 5%, buying demand should shift to renting demand, but both are falling. Every normal feedback mechanism that would restore equilibrium is failing. The market appears to be stuck in a state that should not be able to persist, according to everything we know about how property markets work. The regional picture makes this even more confusing. Normally, in a downturn, we would see clear patterns, with some areas falling faster than others, based on their economic exposure. London might lead or lag. The north might be more resilient or less. But this time, every region is experiencing its own unique version of strangeness. London has seen prices fall sharply, but transactions collapse even more sharply, while prime central areas have seen international buyers return, but domestic buyers vanish. The north has seen prices hold up better, but rental markets implode as landlords exit en masse. Coastal areas that boomed during the pandemic have seen demand evaporate, but supply remained constrained as pandemic buyers refused to sell at a loss. University towns have seen student rental demand stay strong, while family rental demand collapses. There is no consistent regional pattern, which makes national policy responses almost impossible to design. The new build market is perhaps the strangest segment of all. Developers are sitting on land with planning permission, but refusing to build. They have the approvals and the sites, but they are choosing to hold rather than develop. This is economically irrational in normal times. Land loses value if you do not develop it. Planning permissions expire. Holding costs accumulate. But developers have concluded that building now means selling into a falling market with elevated costs, and they would rather take the holding costs than the construction losses. We have never seen the new build industry essentially go on strike before. Even in previous downturns, developers kept building and competed on price. This time they have collectively decided that not building is the better strategy. The housing shortage that has driven the market for years is therefore about to get significantly worse. For those trying to navigate this strange market, I can offer some observations, though certainty is impossible when the normal rules have stopped working. If you are trying to buy, you are in a stronger negotiating position than headline data suggests because sellers are far more motivated than they appear. Properties that have been on market for months will often accept offers 20% or more below asking, but only if you can actually proceed, which most buyers cannot. The constraint is not price, it is mortgage availability and chain reliability. If you can solve those problems, you can find genuine value. If you are trying to sell, you need to understand that the market has repriced, but most sellers have not accepted this. You are not competing against the prices achieved in 2021 or 2022. You are competing against a new reality where buyers simply cannot pay those prices even if they wanted to. Pricing realistically from day one will get you sold. Pricing optimistically will result in your property sitting for months and eventually selling for less than if you had priced correctly initially. The strange market punishes optimism brutally. If you are a landlord, the calculation has become genuinely difficult. The maths that made buy-to-let work for decades has stopped working for many properties. Mortgage costs have tripled. Tax relief has been removed. Regulatory costs have increased. And rental growth, while strong, has not been strong enough to compensate. Some landlords will be better off selling even in a weak market. Others have good enough terms that holding still makes sense. There is no universal answer, and anyone who claims there is does not understand how strange the current environment is. If you are renting, the strange market is actually working slightly in your favour in some locations. Landlord exits mean less competition in some areas as properties are sold to owner-occupiers. Demand destruction means fewer competing renters in locations that have become unaffordable. If you have a good tenancy at a reasonable rent, your priority should be protecting it rather than seeking to move. The grass is not greener elsewhere in this market. Looking forward, I expect the strangeness to continue for at least another 12 to 18 months. The conditions creating these contradictions are not resolving. Interest rates remain elevated. Real wages continue falling. Policy uncertainty persists. Chains remain broken. Landlords continue exiting. New build continues stalling. None of the ingredients for normalization are present. This does not mean prices will crash or that the market will recover. It means the strange contradictory behavior will persist because the forces creating it are structural, not cyclical. What I find most concerning is that the industry and the government do not seem to recognize how fundamental this shift is. They keep applying frameworks from the old era to the new conditions. They expect normal patterns to resume because normal patterns always resumed before. They treat this as a cyclical downturn that will self-correct rather than a structural break that requires new thinking. Until that recognition arrives, we will continue to see policies that do not work, recommendations that do not help, and predictions that do not materialize. The market is acting strangely because the world has changed, and the market is reflecting a new reality that most observers have not yet understood. This is the UK housing market in its strange new phase. The old rules have stopped working. The old patterns have broken. The old wisdom has become unreliable. Those who recognise this and adapt will navigate successfully. Those who keep expecting normal to return will be continually surprised and frustrated. I hope this analysis helps you see what is actually happening rather than what we have been conditioned to expect. Understanding that the market is genuinely behaving differently is the first step to making good decisions within it. Thank you for watching UK Property Info. If you found this valuable, please share it with others who are trying to make sense of what is happening in the property market. The more people who understand this strange new reality, the better